Hi, ladies and gentlemen. I'm Renee Springstead with Fross and Fross Wealth Management and your July 1st, 2024 market commentary. As always, please take a moment and read the important disclosures contained in this email right below the video link. So we're officially halfway through the year, and the great news is that we have seen 30 all-time new highs for the S&P 500. And that's despite some obstacles. The short-term interest rates still looming at that 5% rate. So the Federal Reserve saying that they were going to cut interest rates this year has been put on pause for a little bit. And in addition to that, we're still seeing stickier than anticipated inflation numbers. People have been hoping that they would come down some. But the S&P has most certainly been resilient, and 30 all-time new highs is a very nice thing. But let's take a look back and see, since 2015, what kind of performance have we seen as far as reaching the new all-time highs for the S&P 500? Well, in 2015, we saw 10 new all-time highs, followed by 2016 that we saw 18, 2017 we saw a whopping 62, so that was a good year. 2018 we saw 18, 2019 we saw 35, and even during COVID, all of that going on, we saw 32 new highs in the S&P, followed by a very dramatic 70 in 2021. In 2022, we only saw one new all-time high. In 2020, we didn't see any. And then so that's bringing us to about 275 new highs over the past 10 years alone. Not too bad, right? But it sure does make us pause and wonder. Are we at the peak of the market right now? And if so, historically, what happens if you were to invest right at the peak of the market? Well, we all know that investing at the bottom of the market can result in some very sizable gains, right? But doing so is a little bit tricky. And so we're just going to go ahead and pretend that we got lucky and timed right at the bottom of the market in March of 2009. The return that we would have received is almost unbelievable. It'd be about 900%. The S&P growth then would have annualized to almost 17% a year, each and every year, for almost a decade and a half. And the entire way up, people were like, don't invest, we're in a bubble, don't invest, we're in a bubble. But for us, it was easy because we had a rear view mirror and we got to go back and pick exactly when our hypothetical investment date was. Now let's go ahead and do the complete opposite of that and look and say that we weren't as lucky and we invested right at the peak of the market. We put everything in right at the peak of the market, right before that dramatic downturn. And right away, between 2007 to 2009, the money was cut. Your portfolio would have been cut by about 55%, or over half of what you invested would have been gone. You would have also lost more than 19% during the 2018 correction, 34% during the COVID crash, and 25% in the recent inflation bear market. So if you had the unfortunate timing of picking the exact top of the market right before the Great Recession, what would your returns have looked like, do you think? Well, they're actually pretty attractive. Over the long haul, you would have resulted in about a 350% return on that S&P investment, giving you a 9.5 annualized rate, which is basically what the S&P has averaged over the last 100 years. Of course, you had to sit through some rather uncomfortable periods, but it's nice to know it all comes back to our old saying, it's time in the market, not timing the market, even during some very dramatic situations, that it all plays out. While this is all really interesting data, it really doesn't pertain to the majority of you, because most of you aren't just invested in the S&P 500, right? As a matter of fact, a lot of those really aggressive years are behind you, and instead it's taking a back seat to trying to take a backseat to downturns and volatility, even at the risk of giving up some of the profit in the long term. So instead, really focusing in on the importance of financial planning and particularly on income planning, knowing that you're taking advantage of these very attractive fixed income rates that we have right now for your short-term needs, that short-term bucket, the money that you need now, and then gradually, as the time when you need the money extends, taking on more and more risk to try to keep pace with inflation. So we here at Fross and Fross are absolutely honored to have the opportunity to help you create this plan. And we always look forward to hearing from you. But in the meantime, we hope that you have a wonderful and very safe 4th of July. Thank you so much for joining.